So today, I was scrolling my YouTube comments for yesterday's video, thanks for watching by the way, and it became abundantly clear to me that a huge portion of you guys bought the Russell 2000 right here, sold the Nasdaq 100 right here, and you are now left holding the bag. So today's video is for those of you holding the bag. For those of you whose wife won't divorce you because it simply isn't worth the effort or time. My goal by the end of this video is to make you so much money that your wife is going to want to divorce you. So let's make some money this week. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and apart from semiconductors, a very actually green day across the board. Software 2 did take it on the chin, but I would call it more of a flat showing more than anything. Really, growth in these big names got sold off, and then we really did just continue the rotation we've seen over the last couple of weeks. I mean, financials were very positive. This is on the back of PayPal's earnings. That helped credit services, real estate, energy, industrials. They were all in the green today. We did see a bit of downbeat action. We did see consumer staples take it on the chin after PG's earnings report today. That didn't help the defensive trade along with just everything else rallying today. But the big boys really did weigh on the overall market. Stuff like Nvidia, Microsoft, Amazon, Tesla, Eli Lilly. And that's why the market cap weight S&P 500 was down. The equal weight actually gained today. It was a huge divergence between what the equal weight did and the S&P 500 market cap weight did. And that was mostly on the back of technology and discretionary being in the red. Specifically technology down 2.6%, led by semiconductors. But we're going to see what this is going to look like tomorrow. AMD actually raised its guidance for the third quarter year in 2024. That's definitely going to have an upbeat effect on semiconductors, and we're going to see how that's going to affect technology. The discretionary space, staples down 0.6%, and then materials down 0.3% as well. The best performing sector was energy, followed by financials, real estate, utilities, communication services, industrials, and healthcare. So the broader economy really seeing buy-side action across all sectors and size as well. Small gain, mid-caps gain. It was really just core and growth in the large side that didn't gain. In fact, value in the large sector was one of the best performing factors here today. It beat small growth, small core, mid-cap growth, mid-cap core. So certainly a value rotation occurring under the hood. And as long as we continue to see this type of price action against this, you know, that rotation trade that we are seeing in the market, I think we're going to see this type of price action all the way through August, September, and maybe even through a little bit of October. October is when we can really start to see the growth trade pick up again into the end of the year. Now, the S&P 500 was down 0.5%. The Nasdaq 100 was down 1.3%. The IWM was up 0.38%. It actually outperformed both the S&P 500 and the Nasdaq 100. The RSP equal weight was probably the biggest winner here today. Very crazy price action, very close to all-time highs as well. It gained 0.48%. And then the Dow Jones roughly gained the same. It had a very good day. And it's very clear to see that large size was sold in favor of pretty much everything else. Now, what helped small cap performance today was yields. Yields fell 0.79%. As a result, bonds gained and commodities gained too. Gold was up 1.15%, also on the back of Barry potentially adding more to his gold position, as well as silver up 1.98%. Crude did fall. All in all, the big story when it came to the technical aspect of the market today definitely was the equal weight. In fact, this chart looks very constructive. The equal weight is about, maybe 0.7, 0.8% away from new all-time highs. This is a new all-time high, and above right here, that's a new all-time closing high. So 173, just below the 173 mark is where the RSP makes new all-time highs, looking very constructive. This is very constructive price action from these lows. Bottomed out right here and moved up. And I think that's what the RSP and the IWM and small caps as a whole are doing. We can see that SP 600 sort of like had a bit of a digestion period right here, back to 52-week highs at this level right here. Very constructive. A little less constructive in the IWM. It just hasn't taken this level right here. But the IWM is actually small cap, micro caps. The SP 600 is pretty much more of a small cap index, unlike the Russell, which has a ton of these like small cap, micro cap companies. The SP 600 is pretty much profitable small caps, and you can definitely see that it's moving in the right direction. And that's why I say, don't go out and buy the Russell 2000. We use it as our benchmark, but you want to look at something like the SP 600, maybe the CAF index. Another ticker is XSHQ, small cap quality ETF. That's where you really want your money in the small cap space, not necessarily the IWM. But that's what we're seeing right now in the IWM. We are seeing both digestion of these gains, but also a bit of a rally back to highs. Again, we broke the 52-week high in the SP 600. We'll see if we can get new all-time highs here in the equal weight. And that's probably possible if we get some of the macro data, some of the earnings data, and the FOMC goes our way. We could definitely see a push here up to all-time highs. At that point, probably means more upside. There is nothing more bullish than new all-time highs. Now let's talk about the S&P 600. Now, not much moved in the gamma tape. Pretty much everything stayed where it is. But we do have the call resistance still at the 5300, and that means below this right here, below the gamma flip, we are selling weakness to the 5300 area. This is a line where we'll bounce and find support. Now we can definitely find support and bounce off before the 5300 area, but the probability is very likely that we're going to go to or around this 5300 area in negative gamma. Dealers like to take the price there to hedge their books. That's why these levels are so key. And below negative gamma, if we go ahead, especially break that level, let's say tomorrow we break this low that we made earlier, that definitely opens up the 5300 area. Now I think 5300 is going to be a fairly strong support because we almost used it as resistance right here. We used it as a support and resistance zone right here. You see resistance turn to support. We then came down, bounced off it a little bit, and then continued the move higher. And then if we actually take a measured move from sort of like this green line to new all-time highs, that was a very solid 7% move of that. So it is a very key level. If we do pull back to this 5300, I expect us to find strong support right here and then continue the move to the upside, especially if market breadth continues to do what it's doing. We can see the advanced decline line almost at a new all-time high as the S&P 500 has come lower. That's simply because underneath it all, under the hood, stocks are moving higher. And we can definitely see this with stuff like the RSP pretty much at new all-time highs. The S&P 500 quite a bit off its all-time highs. If we actually take a measured move, you can see the S&P 500 4% from its highs, the NASDAQ 100 sitting at about correction territory, just nearing the correction territory zone here at 10%. I think it's a great time to start nibbling on something like the NASDAQ 100. I think a 10% pullback, if you load up right here, you're getting a very good index. I do think it's going back to all-time highs by the end of the year. And generally speaking, my plan of attack, every time indices or stocks that I like pull back about 10%, right? That's where I load up quite a bit. So I load up every 5%, I'll add a little bit, and then every 10% is where I do a big buy, and then a 15%, 20% on the way down. That way you add at the key levels when the market pulls back. And we generally see markets normally tend to pivot around 5%, 10%, 15%, 20%. If you actually go look at where tech stocks pivoted in 2021, it was about a 21% pullback. That's where they pivoted and went higher from there. So, these 5, 10, 15, 20 levels tend to be good psychological levels. But when it comes to the S&P 500 for this week, things are looking a little bit grim. I still think 5,300 is our downside target as long as we're below 55.25. As long as we're below this zone right here, 5,300 is our ultimate target into August OPEX. And then we can actually bounce from here. If this does move lower to the 5200 area, that's where things get grim, because then we're actually looking at maybe making a lower low, not just on the daily chart, but this is a key level right here on the weekly chart as well. But above the 55.25, we're buying dips, selling rips to the 57.50 area. And guys, earnings is looking very, very good. The fundamental picture actually hasn't really changed. All of these companies are reporting great earnings. And I think if the macro holds up along with rate cuts, stocks look fairly valued, if not cheap, in certain sectors at these levels after just a mere 5% pullback right now. Now, looking at market sentiment, this is CNN's Fear and Greed Index and sitting at the neutral zone. Guys, last week, this indicator finished at the neutral zone. And in that week, we actually saw it go from about here into greed, back into the neutral zone. And this is where we're sitting right now at the 47 level. Kind of crazy volatile price action. It mostly has to do with the large cap selling off, small cap selling up, but market breadth over overall improving. That's why we're actually seeing this indicator stay in the neutral. It does place a bigger weight on market breadth as well as credit market technicals, and that's why it's probably not moving in the same direction like some of the other sentiment indicators. Nonetheless, according to this, sentiment is at neutral and we can actually see more upside. Now, the truth of the matter is the OEX ratio is signaling to us that it is time to start getting into some of the names you like, especially some of the bigger names. This is the OEX open interest ratio. Essentially, it tracks the S&P 100, so the biggest 100 stocks in the US market. And generally, when the OEX ratio gets to this point right here, when the OEX ratio does like trough, this often is a very good signal of institutional buying, and it's a great signal to get long and stay long in the big names. And I think one of the big reasons why institutions are loading up under the surface has to do with earnings. Some of these bigger names, stuff like Apple, Nvidia, Microsoft, have actually had a significant pullback, some in correction territory, into this week's earnings, where 34% of S&P 500 companies are reporting, then next week 9%, and the week after that 3%. But we have a significant amount of S&P 500 companies reporting, and normally when you have stocks coming down into earnings and they beat, they tend to overshoot to the upside. Actually, stocks falling into earnings is a rather good setup to generate alpha, and earnings are coming in a lot better than expected. In fact, we got yesterday's new numbers and nothing much has changed. We actually saw earnings still around 12% and revenue at 4.8%. This is the analyst estimates at the start of earnings season, but the biggest change right now is actually net margins, net profit margins. At the start of earnings season, the estimate was 11.8%. Right now, with 210 companies having reported, 12.1% net margin growth. Guys, this is huge. That is very, very bullish, and I think it's part of the reason why we're seeing this buying under the hood. Institutions know earnings is coming in good, margins coming in better than expected, and when earnings are growing, margins are expanding. That's a great environment for equities. Also, something else, 78.6% of the 210 companies that have reported have actually reported above analyst expectations. This compares to the long-term average of 66%. And something else to note, if you actually exclude energy, S&P 500 earnings is sitting at 13% right now. So right now, earnings looking very, very good. And so far, we've had the highest alpha for beats since the fourth quarter of 2018, when companies beat on both sales and EPS, the stocks rallying upward of 3% one day after. This compares to the long-term average of about 2% and slightly above the average right here for companies that are selling down when they miss on both sales and EPS. So despite where valuations are right now, what the S&P 500 has done this year, and the extremely high expectations on earnings, if you beat on both, you're getting outsized returns, and if you miss on both, the sell-off is not as bad as it is in comparison to history. It's a great setup. It's something that not a lot of people are talking about. Now, we had quite the day of earnings before the open. We had SoFi, PayPal, Pfizer, BP, PG, crazy, Merck as well. After the close, we had AMD, Microsoft, Starbucks, Pinterest, and we're going to kick things off with PayPal. Now, PayPal had a double beat, guys. All of this is recorded pre-market except earnings that happened after the close. Now, PayPal had a double beat. They reported EPS of $1.19 against $1.01. 38% beat, I believe, on adjusted EPS, 19% on GAAP. On revenues of $7.89 billion. The stock was up 7% here in the pre-market. The CEO left some comments. Given the strength of our business, they raised the 24 guidance, increased share repurchases. 2024 guidance was something like $5 billion in free cash flow. They guide for free cash flow. They moved it up to $6 billion. That's a big beat. And then they increased their share repurchases from $5 billion to $6 billion as well. Really good earnings across the board. I'm going to do a further deep dive in a members video, so I'm not going to go deep into PayPal, but great earnings and a basic discounted free cash flow shows the stock like 56% under fair value at 134, and that's just using the trailing 12-month free cash flows multiplied by 7% growth rate. Cash, total debt, shares outstanding, that's the figure you get. So a lot of room to run in the stock. We'll see if this is the catalyst that can take it to the $70 region and above. Looking at a couple of the other big names that reported, AMD, their earnings came in line. However, they raised next quarter's guidance, and that's why they were actually upbeat here in the after hours. Microsoft reported a double beat. but the stock was down 7%. I didn't dive into why. Probably has to do with the guidance issue. Maybe one of those segments didn't perform as well, but the market not really liking their earnings. Starbucks earnings came in line. First Solar earnings came in line. It was a very, very mixed day across the board, but we're going to see how the market's going to move tomorrow with better than expected guidance for AMD and Microsoft being down. So are we going to put more weight on semiconductors, infrastructure, or software tech, or is just all of tech going to get sold as a result? But very mixed earnings here today. So on this channel, we look at a lot of macro, and today we're going to look at some macro indicators that are a little bit scary to me because we have to look at both sides of the aisle. This right here is 60-day loan delinquency rate, prime and subprime auto loans, and we could actually see that we are ticking levels not seen since 2016 here in prime autos. And when it comes to subprime auto loans, we're looking at levels above. It's concerning. You don't want to see delinquencies tick up in the way they have. At the same time, credit card delinquencies are also ticking up to near post GFC levels. And this is telling us that the consumer is softening under the hood despite the growth numbers and employment numbers we're getting in the market as of late. On the topic of employment, payroll growth excluding government, healthcare, and education has actually fallen below the zero line. This right here is often a strong indicator of an incoming recession, and we have to see where this tails off to. A lot of this that we saw, we thought was normalization, but when normalization keeps dipping, it becomes a problem. And once payroll breadth falls below 60% of industries, equity performance tends to suffer, as you can see right here, here, and here. And you can see some pretty crazy max drawdowns if you look at this table right here. However, we are not there just yet. We are just above the 60% line. And that's why this week's NFP numbers are absolutely key. We get NFP on Friday and the expectation is for 225,000. That's BOFA's estimate. Consensus 175,000. Something else that's going to bring volatility this week is the FOMC rate decision. And I just want to bring out a chart right here. And this is essentially how I see FOMC. Last time we saw the market fall into FOMC was in May, and there seems to be a noticeable difference in the current setup compared to then. The sell-off in equities in May was almost perfectly correlated to rate cut expectations dying as Fed fund futures dropped and priced out cuts. Equities rebounded with the return of rate cut expectations over the next few months, as you can see right here. This time, things are different. Equities have sold off, but rate cut expectations have actually risen. Very interesting. So realistically, there's actually no dovish fuel left in the tank for equities into this FOMC outside of just cutting rates. This leads me to believe that if we see equities continue to leg higher, the driver isn't the Fed anymore. It's something else. A lot of this rally is predicated on rate cuts. If equities keep going higher from here, then it's more than just easier monetary policy driving fund flows. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.